This is Nightly Business Report with Tyler Matheson and Susie Gehring.
The bulls get trampled. The Dow drops more than 250 points. The Nasdaq has its worst day since November of 2011. The reason? No one can really explain it.
Here come the banks. JP Morgan and Wells Fargo report earnings tomorrow, and what they say could determine whether the selling continues.
Game changer? Now that the curtain is being pulled back on how doctors are reimbursed under Medicare, are more big changes ahead? Howard Dean joins us with his prescription for health care. All that and more tonight on Nightly Business Report for Thursday, April 10th.
Good evening, everyone. A nasty and dramatic sell-off on Wall Street today with a rare triple-digit loss on the Nasdaq. Red was the color of the day, with all 10 S&P sectors down sharply. Here are the sobering numbers. The Dow tumbled 267 points. The Nasdaq plunged 130 points. That's a 3% drop and its worst day since November of 2011. And the S&P stumbled 39 points. That's a 2% slide. One big reason for the Nasdaq decline, more selling in biotech stocks. Take a look at the biotech ETF plummeting more than 5.5% today. So what happened? Surprisingly, traders and market pros were stumped. Usually they blame a steep slide on an economic report, a global crisis, or even the weather. But there was no one real culprit today. In fact, there were some encouraging news on the economy, with upbeat reports on jobless claims and home disclosures falling to 7-year lows. We have two reports tonight looking at the market action from the New York Stock Exchange and the hard-hit Nasdaq. We begin with Sheila Dharmarajan at the Nasdaq.
Today's action is quite the reversal from the two-day rally we saw earlier in the week and more than wiped out those gains. Getting hit the hardest are the biotech stocks. Nasdaq Biotech Index down nearly 6% on the day. And also high-flying so-called momentum stocks. Now, these are stocks that consistently move in a direction regardless of news. Now, that direction is down with names like Tesla, Micron, Priceline, Netflix, declining more than 3% today. As for the why, there's no particular reason that can be blamed. After all, the economic reports have been somewhat strong, and earnings season isn't quite in full swing yet. So traders I speak to say there's simply a shift in momentum, and investors are taking profits. Keep in mind that the Nasdaq did rise more than 35% in 2013. Now, as for whether the sell-off will continue, earnings season, which kicks off with the big banks tomorrow, will be the next catalyst for a move in either direction. For Nightly Business Report, I'm Sheila Dharmarajan at the Nasdaq market site.
After big gains yesterday, it was an ugly day for the markets. Healthcare, tech, consumer discretionary, and financials were among the biggest downside sectors. It's a confusing moment for the markets because it's not clear where the economy is going. The bears are arguing it's hard to force the markets higher without clear evidence the economy is improving. Today, they held the upper hand as traders sold stocks and bought bonds. But the bulls have been arguing that the economy is improving, but we are not going to blast off in the month of April. There is a gradual recovery, and there is no reason to pay a lot of money for overpriced growth stocks like Pandora or Tesla or Yelp if the economy is improving, because you could get modest growth cheaper by buying old school names like IBM or Caterpillar or even Microsoft, all of which have had modest gains this year. So who's right? Well, we will get greater clarity when companies begin reporting in earnest tomorrow and begin offering guidance for their current quarter, like Wells Fargo. Here's one canary in the coal mine to watch. There are 8 IPOs that are scheduled to begin trading tomorrow, including restaurateur Zoe's Kitchen. It wouldn't be a big surprise to see one or more of them postponed due to poor market conditions. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And joining us now to talk more about today's market sell-off is Jim Paulson, Chief Investment Strategist at Wells Capital Management. Mr. Paulson, welcome. Good to have you with us. Should any one of us be surprised that the market is selling off, most especially Nasdaq, where the price-to-earnings ratio is something like 35 times?
No, I don't think so, really, Tyler. I mean, it's been a long time since we've had, what, a 2% decline in the S&P or 3% decline in the Nasdaq. And I think that's what the market does every now and then, just make sure our hearts are working for us investors. But yeah, I think we've had a big valuation correction in one small part of the marketplace, the biotech, momentum, high-flying story stocks. maybe that's not all a bad thing longer term for investors, but in the short term, it's been very sharp and very eye-catching.
All right, so we've been having this zigzag kind of trading for a while now, Jim, but I mean, is there something else going on? Is this going to be that correction that so many market strategists have been talking about?
One never knows, Susie, and I certainly don't either, and it certainly could continue on. There wasn't a big show of any bottom tonight, but my guess is it's more of an opportunity here than the start of a 10% or more correction, primarily because the underlying economic reports here remain very favorable. They continue to surpass expectations. This morning's report on unemployment claims was another report that was better than people thought, suggesting the economic momentum is very good. If that stays in place, then I think greed will return to this market, and more people will start looking at lower values and start stepping up again, pushing the market higher. So I don't know if it goes much lower. I think if we do have a correction this year, it'll be from higher levels than we have right now.
Let's bring in Joe Duran, CEO at United Capital Advisors. Joe, welcome. Jim Paulson just made the point that for the most part, the selling has been concentrated in what we describe as the momentum names, the stocks that go up because they've been going up, basically. Biotechnology, small caps, technology. But today, certainly, and in recent days, there has been some bleed through to the Dow stocks and to the blue chips in the S&P 500. How vulnerable is this market? And is this a time to buy the companies that have been on your buy list and you've been waiting for them to come down?
I think that the market is vulnerable. What I look at are two things for me that tell signs of when you should be stepping in safely. We are very optimistic in the long term, but there are times which you want to be careful. And right now, there are two things that concern me. The first one, most importantly, is we had a pretty big down day today. We've had a couple of them, and the VIX, the measure of fear, is really not reacting the way you would expect given an almost 300-point drop. So we were only up a couple of points today to 16. And you want to see that approaching 20 as a relatively safe entry point if you're in a big decline. The second thing that concerns me, frankly, more in a long-term sense, is what's been happening with the bond market. When you have interest rates flattening out, that's telling you that the bond market thinks that the economy is not doing as well as we all think. And a lot of us who are optimistic have been hoping for a significant pickup in the economy in the second half. I'm not sure we're going to get that. And the bond market tends to be more right than the stock market. So I'm a little bit concerned with that as well. And I think, as I mentioned in your show a couple of days ago, I was nervous that things are not looking the way I would expect if we're really, in fact, in the middle of a continuation of what has been an amazing move.
So if you're nervous, Joe, and you're saying it's a little bit risky to be buying stocks, even though they're buying opportunities, is it risky to hold on to stocks that have been doing well, you still like them, the fundamentals haven't changed, but you see big sell-offs on them? And I'm looking at companies, whether it's Google or Facebook or Netflix, that today we're down by 4% or more. Is it too risky to hold on to these?
No, I think the first thing that everyone should do is make sure that their overall allocation is right. We talked about this at the end of last year. When you have a big 30% move in stocks and the bond market is negative, your ability to have an allocation that's far more aggressive than you should have is very easy. And the market is still relatively flat for the year, so we should hold it in context. It's been disappointing because we started the year off quite well. But the thing to hold in context is to say, we're still doing fine. Look at your overall allocation and don't make any abrupt moves. Now, there are a lot of day traders who I can't advise, but long term, you want to be careful.
Jim, respond to what Joe just said.
Yeah, I think, Joe's looking at bond yields that have come down, but really bond yields have been in the same range now since last summer. I don't know if there's any strong message there. What I'm attracted to is some of the messages coming out of the equity market in this pullback, Tyler. Look at the relative price performance within the inner-term makeup of the market here. The emerging market stocks are doing phenomenal on a relative basis. They're now outperforming the U.S. stock market year to date. Within the United States, the industrials are holding up well, the transports are holding up well, the basic material stocks are holding up well. In other words, the most cyclical areas of the economy are doing very very well through this pullback, which tells me this is more about a short-term valuation adjustment in one small part of the market. The broader part of the market still is showing signs of improvement in the economy. And I think, if anything, we're doing good things with this. We're bringing down rates, bringing down the hurdle for stocks. Right. We're creating a little fear, which is causing people to raise some cash. That's new buying power for the future. And we're cheapening stocks overall. And I think we're setting ourselves up for another rally to higher highs before this year's out. So I look at this more as a buying opportunity rather than something that you should run from.
And Joe sees it the other way. And there
I agree a little.
Sorry. We have to leave it. I'm sorry, Joe, very much. But that's how a market is made. Jim sees it one way, Joe a little more cautiously, and he says we're not afraid enough yet. But at any rate, thank you, gentlemen. Jim Paulson, Wells Capital Management, Joe Duran of United Capital Financial Advisors.
Well, as we've been reporting, there could be a lot more turmoil in the markets tomorrow because two of the nation's biggest banks report first quarter earnings. We're talking about Wells Fargo and J.P. Morgan Chase. Kayla Tausche joins us now with a preview of those closely watched earnings releases and what investors will be looking for in the numbers. You know, Kayla, when people look at banks, they're always thinking about mortgage fees, loans, trading revenues. Are these going to be the drivers of bank earnings or something else?
They will. And Susie, there's a little bit of something for everyone. There's a little bit of good, a little bit of bad. The good thing is banks are ultimately barometers of the underlying economy, and the economy is getting better. Credit is improving. Loans are growing, albeit slightly. Consumer spending is up slightly, but trading revenues are expected to be negative. Unfortunately, the weather hurt the banks as well as the retailers. They are not immune from this. A lot of people were not trading during those harsh winter storms that happened all throughout the quarter. Nomura says that alone could drive revenues down 10% at some of these big institutions that have very active investment banks.
How much are some of the legal settlements going to affect the earnings, or has that wave crested?
You know, Tyler, it feels like we're in the eye of the storm here. We're not in the worst of it on either side. It seems like we're just in this very awkward, quiet period. We have had a couple of scandals erupt, but we haven't seen the end of those. So, for instance, fraud in Citi's Mexican unit, that was news that broke this quarter. A lot of banks are also being investigated for foreign exchange and interest rate rigging still. We haven't seen those settlements come to pass. Now, we do have the bulk of them behind us. A lot of settlements from Bank of America on the mortgage front. They had a big settlement with the FHFA and with some of their private investors. And then we also had J.P. Morgan's well behind us. So you're not going to see some of these giant blockbuster fees paid, but this isn't the end of it, certainly from the legal front.
All right, so you mentioned a couple of banks. You know, when you sort through all of it, which ones are expected to report solid results? Which one won't be? You know, what are you hearing from the people you're talking to?
Unfortunately, Susie, no one really thinks this is going to be a blockbuster quarter. They have raised estimates for Wells Fargo for the year, thinking that more home buying and rising interest rates will help Wells Fargo. Citigroup is one that, on the downside, people are still not willing to say is a buy just yet because of all of the issues plaguing Citigroup.
Kayla, thanks very much. Kayla Tausche reporting for us tonight. A setback for consumers fighting some other big banks. A federal judge dismissed a lawsuit against three of the nation's largest credit card issuers, accusing them of colluding to require that cardholder disputes be settled in arbitration hearings rather than by class action lawsuits. Despite the win, shares of all three of those credit card giants named in the suit, Citigroup, American Express, Discover Financial, all ended lower on this down day in the markets.
We have an update now on the troubles at General Motors and the recall of 2.5 million cars for faulty ignition switches. Now the automaker says it'll take a $1.3 billion charge in the first quarter for the cost of all those recalls. That's much more than a previously announced charge of $300 million. Also, GM has placed two of its engineers on leave with pay for their role in delaying that ignition switch recall.
And still ahead, now that we know more about how much doctors get paid from Medicare, will it lead to greater change? Former Vermont Governor Howard Dean and a physician discusses the future of the healthcare industry. Some good news from a troubled economy. Greece, in that nation's first bond offering in 4 years, when it was bailed out by Eurozone officials, the country saw strong demand for its debt today, raising more than $4 billion from investors.
And some good news on the U.S. federal budget deficit. It's shrinking. With more Americans working and tax receipts, of course, growing, the government's budget shortfall has dropped to just $37 billion in March. That's down from $107 billion in the same month last year.
Shares of Ally Financial stumble in the company's trading debut, and that is where we begin tonight's market focus. 95 million of Ally's shares were offered at the low end of the expected range, $25 apiece. The sale did raise about $2.4 billion, making it the year's biggest initial public offering so far. Now, the shares were sold by the U.S. government, that means you and me, which took the $17 billion stake in the auto lender during the 2008 financial crisis. The shares were off 4% in the debut to $23.98. Shares of Rite Aid surged after the drugstore chain announced a full-year sales forecast above analyst estimates. The company expects to benefit from new generic drug launches and thinks it will enroll more customers in its loyalty program. Earnings easily topped estimates because of strong pharmacy sales. That sent the stock up 8.5% today to $6.94.
Well, it was the opposite story for Family Dollar. The discount retailer announced an earnings miss, blaming harsh winter weather. It also says it'll close 370 stores and cut prices on a lot of basic items. Shares fell more than 3% to $57.17. eBay and Carl Icahn have ended their proxy fight. Icahn agreed to drop his proposal that the company split off its PayPal business, and he withdrew his 2 nominees from the board. But eBay will appoint one of Icahn's suggested members. The company's CEO says eBay will now focus on growth.
We thought we were going to win the vote, but, Carl himself said, look, let's make peace, not war. This proxy battle was not something that was helping eBay shareholders or helping us innovate and execute more effectively. So now that's behind us, and we can focus on what's most important, which is competing in the market and driving strong innovation, which will drive strong growth.
Despite those optimistic comments, eBay shares fell more than 3% to $54 and change. And Merck says its hepatitis C treatments showed a 98% cure rate in a mid-stage trial. The 2-drug combination pill stopped the virus in newly treated patients with few major side effects. Despite that, Merck couldn't escape the downdraft in the markets, and its shares lost more than 2% to $55.85.
A new milestone for the Affordable Care Act, President Obama's signature legislation. Figures out today from Health and Human Services show more than 7.5 million Americans have signed up for a health insurance plan through the ACA's state and federal online marketplaces.
But doctors, patients, insurers, and regulators are still talking about another batch of numbers. We're talking about those Medicare payments to physicians that yesterday were made public for the first time ever. Joining us now to talk more about them, Howard Dean. He's former governor of Vermont and an advocate of universal health coverage for Americans. Mr. Dean, thank you so much for coming on the program to talk about this. Now that we know more about what doctors are getting paid, do you think that this is the beginning of a game changer, a change movement between how physicians, how patients, how regulators all interact with one another?
I do think so, although this is not the beginning. This has been going on for a long time, but this is a major milestone. One of the biggest problems in medical care, as we know, is lack of transparency and costs that have been out of control for 30 years, exceeding the rate of inflation every single year for 30 years. So transparency is the first step towards trying to figure out what's the matter with the system. And I think these figures are in some ways shocking. And now we're going to drill down on those figures, find out why these folks are getting paid what they're getting paid, and whether the care they're delivering is worth it, not only to the people who get it, but also to the American people.
Governor, one of the things that stood out to me was that it goes to the heart of what is described as fee-for-service medicine.
Right.
The doctors who performed the more services got the more fees. Big shocker there. Is that the heart of the problem in American medicine today?
Yes. It's the heart of the problem. People are always fond of blaming trial lawyers or insurance companies or drug companies and all so forth. The biggest problem is we have an incentive system to spend as much as we possibly can. And if we're ever going to control costs in this country, no amount of tort reform or different compensation systems are going to be fixed unless you get rid of fee-for-service medicine. And I think that has now become widely accepted among people who really understand how to deal with health care. So that's, interestingly enough, Obamacare, because it created this ACO, the vertically integrated healthcare systems, is now able to move towards a flat fee basis, take all comers for a flat fee per patient. And that is going to get rid of this incredible drive to do many, many more procedures than are necessary.
Mm-hmm. But do you see a downside to that? You know, the American healthcare system is raved at all around the world for its high quality, its fantastic doctors. Is there a downside?
There is a downside. First of all, of course, there's cheaters in every profession, and mine is not an exception. So there will be people who short patients. Right now, people are endangered by getting too much care. You can be endangered by getting too little. But we spend almost twice as much as the next country as a percent of gross national product. So there's a lot of downside, and there will have to be some regulation. The other greater danger, which we're going to have to deal with, is the question of innovation. If you can sell 10,000 medical devices, you can make money off cutting-edge medical devices. If you can only sell 3,000 because you don't really need those other 7,000, and people are putting them in to take advantage of fee-for-service medicine, then you may not be able to make money. So you do have to worry about innovation. But we cannot afford to keep on with fee-for-service medicine. I think you can say goodbye to fee-for-service medicine. It may take 2 years, it may take 5 years, but we can't continue in this spending pattern.
And so, just to clarify, what replaces it?
What replaces it essentially is a model that looks very much like Kaiser. You sign up for Kaiser, you get comprehensive care, and you get you pay a flat fee, and that's all they get. So their incentive is to take care of you. This is essentially a way of financing a wellness system. Right now, we have an illness system. We get paid a lot if you get really sick. What we'd like is to get paid a lot essentially by saving expenditures, by keeping you healthy, keeping you out of dialysis instead of putting you into dialysis. And that means early taking care of diabetes, early taking care of high cholesterol, early taking care of obesity, and not waiting until you end up in the intensive care unit for those problems when you're 55 or 60.
All right, Governor Dean, thank you so much. Howard Dean, former governor.
Thanks for having me on.
Of Vermont. It's our pleasure. And coming up, the weather warms up. Are some of the nation's biggest retailers seeing a spring thaw in their monthly sales? That's coming up. A huge settlement from a now shuttered hedge fund, which will pay the largest criminal fine ever imposed for an insider trading case, $900 million. A federal judge worked out a deal where SAC Capital, founded and run by billionaire founder Stephen A. Cohen, will pay a total of $1.8 billion after the firm and 3 subsidiaries pleaded guilty to wire fraud and securities fraud charges. 8 former employees of SAC Capital, which has been shut down, have been convicted of insider trading.
And Walmart is going natural. The world's largest retailer is teaming up with organic foods maker Wild Oats to market more affordable, all-natural packaged foods to its bargain-conscious shoppers. Walmart expects the new Wild Oats organic offerings to cost 25% less than other organic brands it sells. Shares of Walmart down 1% today, while shares of organic foods retailer Whole Foods dropped 4%.
Well, tight-fisted consumers are not just watching what they spend on food. They're cautious about all kinds of spending, as we saw in the sales drop at a number of clothing chains that reported March numbers after the market closed today. Take Gap stores, for instance. Sales fell 6%, and numbers from its namesake stores were well below expectations. That sent shares initially lower in after-hours trading. Courtney Reagan has more on the impact of all that wicked winter weather as retailers hope more consumers catch a little spring fever.
This year has been harsh for retailers, with severe winter weather keeping shoppers at home, cranking up the heat, subsequently cutting into budgets. With spring weather slow to sprout across the country and Easter landing 3 weeks later this year, Wall Street had low expectations for retailers' March sales. However, Costco managed to surprise to the upside, with sales at stores open at least a year gaining 5%. Shopper traffic also up 5% for the month, though analysts say recently Costco is a rare, steady standout in the retail space.
Shoppers went and bought groceries to stay at home. Also, on top of that, we have the shift of the Easter effect, which definitely benefited one more day in the month of March and helped sales for Costco.
L Brands, the retailer that owns The Limited, Victoria's Secret, and Bath & Body Works, saw March sales fall 1%. Better than expected, but certainly not inspiring. FBR analyst Susan Anderson thinks L Brands is going to have to increase those promotions to clear some of the inventory that didn't sell. That's helpful, though, for consumers looking to fill Easter baskets and spring wardrobes.
The month of April, we're going to see consumers receive a boost from their tax returns. And also, we usually find that historically, the month that Easter falls in tends to perform very well as consumers go back and buy new spring merchandise at full price. On top of that, there's some pent-up demand because shoppers have stayed at home for the past few months,
leaving retailers and investors hanging hope on the Easter Bunny. For Nightly Business Report, I'm Courtney Reagan in Tucson, Arizona.
Finally tonight, a big change coming to the late-night TV landscape. It took less than a week for CBS to tap comedian Stephen Colbert to succeed David Letterman when he retires sometime next year after hosting late night for more than 2 decades. Colbert is host of the Colbert Report on cable's Comedy Central for the last 10 years. He inked a 5-year deal to join late night on CBS. No word on how much the deal is worth. Plenty, I bet.
Big bucks, absolutely. That's Nightly Business Report for us. I'm Susie Garrett. Thanks for watching today.
And I'm Tyler Matheson. Have a great evening, everybody. We'll see you back here tomorrow night.
I'm Susie Garrett with a Nightly Business Report news brief. A dramatic sell-off on Wall Street today with a rare triple-digit loss on the Nasdaq as biotech companies plummeted. Traders were stumped over why stocks tumbled so sharply, especially after upbeat reports on jobless claims and home foreclosures. The Dow lost 267 points. The Nasdaq plunged 130 points. That's a 3% drop and its worst day since November of 2011. And the S&P stumbled 39 points, a 2% slide. Good news on the budget deficit, it's shrinking. It fell to $37 billion in March, down from more than $100 billion a year ago. And General Motors will take a $1.3 billion charge for its ignition switch recall and place 2 engineers on leave with pay for delaying it. Be sure to tune into Nightly Business Report right here on your public television station.